Welcome to the MTA Podcast Series, a weekly audio cast featuring interviews with recognized industry professionals. And your host, Ed Carlson.
If it's Tuesday, it must be the MTA Podcast Series. And it is. It's Tuesday, January 12th, 2010. We have said it before and we'll say it again. The structure of the current bear market is corrective. This means that a larger underlying uptrend is still in effect, which does much to confirm our long-standing view that the 2002-2007 pattern was either the B wave of a large degree fourth wave or the first leg of a large degree fifth wave. Both counts mean that higher highs are still out there. Today's guest is Walter Murphy, the managing partner of Walter Murphy Global Advisors. Walter has followed the financial markets professionally for 32 years. From 1984 to 2009, he was a senior technical analyst at a major Wall Street firm. Walter maintains a significant personal database and is a recognized expert in the Elliott Wave Principle. He has a BA from the College of Holy Cross and an MBA from Babson College. Walter also holds the CFA designation, but we won't hold that against him, and he's not a musician. Walter Murphy, welcome to the program.
My pleasure, Ed. Thank you.
Just wonderful having you here today. I suspect that a lot of folks who call themselves Elliott Wave analysts, that after today's interview, they're going to be feeling like they have slipped into consensus thinking. And I believe that our time with you is going to end up being a real challenge for a lot of people to come to grips with, and I'm really excited because of that. But let's go back to the beginning. You say a BA from Holy Cross and an MBA from Babson. Tell us, give us a little history here. Did you take off any time between undergrad and graduate school? What did you do during that time? Fill in the blanks between your education and your time at Merrill Lynch.
Yeah, actually I did take off a little time. After I graduated from Holy Cross with the very valuable degree in political science, I moseyed off to Cape Cod, built houses for a couple of years.
Oh, really?
Yeah, and I still, when my kids were little, I would take them around to the various neighborhoods and show them the structures that Dad built. But the tail end of that was 1974, 1975, when the housing environment was sort of reminiscent of what's going on now. Mm-hmm. And I took the opportunity to head off to Babson in Wellesley, Massachusetts, and got my MBA there in finance. And from there, and I did that in fairly short order. I think it was all of 18 months. I went full-time summers and whole 9 yards. And then from there, I moseyed off to New York, which is a bit of a shock, being an ardent and still am an ardent Red Sox fan and going into Yankee land. As a result, I have one son who's a Red Sox fan and one son who's a Yankee fan, who I refer to as my mutant gene. And went to work for Standard & Poor's Corporation in the equity research department. The S&P has its reputation, I guess, as a rating agency, but it also has a very large and well-regarded equity department. And I spent 4 years there as the utility, both natural gas and electric utility fundamental analyst.
Oh.
And and thus the CFA that you alluded to earlier. And then after 4 years, I was asked to run the entire department, which I did for another 4 years. And it was during that period of time that I became interested in technical analysis, because it became fairly clear to me fairly quickly that the fundamentals, while I had been doing that as my livelihood for 4 years, were applicable to individual company research, not so much from the macro point of view. And at that time, Joe Granville was very hot, so I went out and read his book and got into technical analysis, specifically OBV interested first, but broadened it out. And while I was doing that, one day a guy walked into my office who I had never seen before and have never seen since, and dropped off the 12 Elliott Wave articles written by Ralph Nelson Elliott on my desk. It said to me, I thought you'd be interested in this, and off he went. As I said, I never saw him again.
Isn't that something?
So I started the hourlies and all that kind of thing fairly quickly, and frankly gave up on Elliott Wave. I wasn't clicking. I didn't understand what was going on. But 6 months later, I went back to it and the light went on, as I say, and I haven't looked back. I've been doing it ever since. Obviously, after that, I started doing all sorts of readings. I've obviously read the Proctor and Frost book, Hamilton Bolton's book, and just practice. When you do this for 30-some-odd years, it becomes... but I'm always learning. That's how that works. And then a friend of mine, in about 1984, who had been at S&P, came over and said... and he had gone to Merrill Lynch, and he came over and said to me that Bob Farrell was had a position open. Would I be interested? So I said I would. The friend arranged an interview. I interviewed with Bob, and he basically hired me on the spot. And I began work in, I think it was April of 1984, and the rest, as they say, is history. So
yeah. Well, I wanted to ask you a little bit about your time at Merrill Lynch. The most interesting thing I've noticed was, Merrill has a team of technical analysts, or at least they did before the Bank of America merger. But what I always thought was so interesting was that every week there were two reports. There was a report which was headed by Mary Ann Bartels, and they had everybody's name under hers on the report. And yet, then there was a separate report that came out which simply had the name Walter Murphy on it. Now, how was it that came to be, that they broke out your reporting from everyone else's?
Well, basically, it was nobody else did what I did. The same was true way back when. When I started at Merrill, there were 14 analysts in the department, technical analysts in the department, and each of us was allowed by Bob Farrell, but also because of the number of analysts, basically to do our own thing. And my thing was primarily Elliott Wave. And Bob had experience with Elliott Wave because Bob Proctor used to work for him. And that was part of the hiring understanding. And so even back then, you would have everybody putting out either group reports or the entire department reports, or somebody who was specialized in something specific, such as myself or Elliott, would have just his or her name on the report. And that kind of carried through. So the reports that you're probably talking about that had all the names with Mary Ann were basically, the macro market comments type of a thing, whereas mine was very specific, geared towards Elliott Wave.
I see. Well, so now you've got your own firm. Tell us just very quickly, what's your typical day look like now compared to your typical day at Merrill?
The funny thing is that since my commute is minutes rather than an hour each way, one of my long-standing jokes here is that I don't know where I had enough time to have a job at Merrill, because it is busy when you're running a lot of your own things. I like the analysis. That's what I enjoy doing. And I spend a lot of time during the day analyzing and also writing. I put out a blog most days. Every month we put out what I refer to as our monthly insights, and then several times a month we put out a short-term review. So there's a lot of writing and therefore a lot of analysis going on. As you mentioned in the intro, I keep a fairly significant personal database, and that by itself takes 2 or 3 hours a day just to just to maintain. So, and then there's the running of the business. We are taking subscriptions and replying to subscribers, to people who are interested in subscribing and all that. So it can be a fairly full day, even though, as I said before, my commute is a lot shorter than it used to be.
This database you mentioned that takes 2 hours to update, are you doing that by hand as opposed to having it automated?
It's a combination of both.
Okay.
I mean, there are some things that it's hard to download, say S&P hourlies. That's typically not something that's available. But one of the other things, as an example, I keep the daily closes of 24 S&P industry sectors that I am able to download. So it really is a combination. And of course, that also involves looking at the charts, not just inputting the raw numbers. You want to look at the charts.
Right. We're going to continue with Walter Murphy in a moment, but first a reminder that on next week's program, we'll have from Bloomberg Surveillance and Bloomberg on the Economy, Tom Keene. Walter Murphy, when it comes to Elliott Wave, you would seem to be out of the consensus. That is, your belief that the post-2000 time frame constitutes a fourth wave and that there are still higher highs out there. You know, to understand this, I've found your research going back to 1929 helpful, and your conclusion that there were no impulsive rallies between 1929 and 49, even though most Elliott Wave analysis counts that as the beginning of a five-wave move that most think has ended. Talk to us about this 1929 to 1949 period, would you?
Yeah, sure. I will say this as a little bit of an aside. You mentioned the consensus. I once mentioned to Bob Farrell I was concerned about something because it seemed at the time that all the Elliott Wave analysts were thinking the same thing. And he looked at me and he smiled and he said, well, you can take all the Elliott Wave analysts and put them on through the eye of a needle, so I wouldn't worry about that. And that's from the guy who a lot of people credit inventing sentiment too. But yeah, you're right. One of the things that I look at, if you look at a chart of the Dow or the S&P, and just look at that 1929 to 1932 advance, if you don't dig into it, go into the nitty-gritty details, it does look like a five-way pattern. But I have gone into the nitty-gritty details of it, and I have an objection. Believe that the decline from the 2007 to 2009, the 07 high to the 09 low, was a five-way pattern. There are arguably five waves there, but it doesn't break down satisfactorily. So I've actually developed a little saying that says the ability to count from 1 to 5 doesn't make you an Elliott Wave analyst. If I look at the structure of the Dow, and especially the S&P from 1929 to 1932, it just doesn't show up as five-way patterns. It overlaps and that kind of a thing. And I also am cognizant of the fact that Elliott himself argued for a long time that there was a fourth wave triangle going from the 1929 highs to 1949. So that boasted by confidence a little bit. So that research report you referred to is I basically went back and tried to divide the market action from 1929 to present into four large segments to see how it fit. In terms of the big picture count. And I was reasonably confident with the idea that you really could not find, in my view, a satisfactory five-way structure.
You said something very important. I'd like you to repeat it. You said that Elliott himself had referred to a triangle, was it, between, what were those dates? And where can a person find that information that Elliott wrote that?
Probably the easiest place to look at it is in some of Bob Proctor's books. That's the most easily available source at this point. Bob and A.J. Frost began writing a long time ago, and Bob has done a very, very thorough job on Elliott's writings, so you should be able to see reference to that. My recollection, and it's been a while since I've gone through it, that Elliott himself kind of flips back and forth between 1942 and 1949 as a triangle, but he was talking about a triangle and was basically, I think, arguing against the 29 to 32 rally as an impulsive pattern. But if it was a triangle, by definition, that makes it a big fourth wave. So the argument there is that the triangles are always either fourth waves, the penultimate pattern, as I like to call them. So everything since then has been a fifth wave of some degree. My own sense is that I'm satisfied with the idea that the rally off of the 1949 lows, July of 49, was impulsive in nature, and continued to be impulsive in nature until at least 1966, and you can zig your zags a little bit and even stretch it to 68. But it was at that point that, and at that point I say, okay, you had one big five-way pattern, and that was wave one of a larger five-way structure. I would make a case that from 1966 to 1974 was the second wave. There are those who say it stretched out to 1982. I'm not going to quibble about that at this point. Again, it's how you zig your zags. But my own sense is that you did have an impulse wave from off of the 1974 lows. So I think that was wave one of what I consider to be the third wave from the 1949 lows.
Well, why don't we fast forward to the top of what you would call both the third wave as well as the top of the B wave of wave 4, and explain those dates for our listeners.
Well, that's it. I mean, from 1974 to 2000, you had one of the great bull markets of all time, and that really very much fit the characteristics of a third wave, which again bolstered my count that you were in a post-1949 fifth wave, and within that you were within wave 3, and therefore 2000. I can argue 1999 as the orthodox top was actually the peak of wave 3 from the 1949 lows.
All right,
and that's why I said at the time, and you quoted it earlier, that there was still a fifth wave out there someplace. And I've since quoted several times as saying it's not this financial crisis I'm worried about; it's the next one.
It's the next one,
because we're still in a fourth wave. And my point there being is that both the decline from 2000 to 2002 and the rally from 2002 to 2007, in my view, are clearly corrective. There's no impulsivity to them whatsoever. So they are larger corrective structures within that still ongoing fourth wave.
And so, for those of our listeners who aren't acquainted with your work, just tell them how you count the July and October 07 tops.
I basically go with the idea that the July high was the orthodox peak of the low from 2002, and that you've been doing a sort of a complex pattern ever since. And so my thought is that, call it a double three, for example. My basic point is that the decline from the July lows was A, you had a rally as in a regular B to the October highs in 2007, and then C into the spring of 2008. The rally into May, therefore, was an X wave, and everything since then was the second pattern within a larger double three, as they call it. What I would, that's to people who aren't familiar with Elliott, that's a little bit of gobbledygook, but I think the key element to me is that the decline from October 07 to March of 08 was not impulsive.
Got it.
And if it was not impulsive, then the larger structure cannot be 5 waves down into the 08 lows. So if the very first leg was not 5, then the whole thing cannot be 5.
Right.
The building block is gone. So for those who call that decline from 2007 to 2009 as primary wave 1, I think they're mistaken. I think it's something a tad more complex and therefore more benign, if you will, rather than still looking for waves 3, 4, and 5 to the downside ahead.
We've still got one topic I want to at least touch on before we conclude today. But to conclude this topic, just to be clear, you are you not expecting the market to take out the March 08 low?
I think the March 08 low should be at least severely tested. I think the orthodox low was November of 08. So that's my first objective. But yeah, I don't think we're done on the downside yet, primarily because the rally from 08 is clearly corrective. It's a bear market rally.
All right. Walter, in 1 minute or less, can you share with our listeners both the traditional use of the Kopic curve and your, shall we call it a hybrid method of using the Kopic curve? I think this is fascinating, and I think a lot of people would find it interesting as well.
Well, in 1 minute or less, way back when, if Elliott was priced, I was looking for other indicators. You don't do Elliott in isolation, and the Kopic curve came across as being a great momentum indicator. And I can't say mine is so special. I give a big tip of the hat to Ian Notley and Jonathan Otter, who've been doing this for years. And basically what I try to do is up the ante a little bit and do the Kopic from hourly up to yearly data to find out what the varying degrees of trend are. And the Kopic curve is basically a momentum indicator. And my sense is that if you look at the annual Kopic curve, that is the Kopic based on yearly data, closed yearly data, that's been down since 2000, which argues that we have been in a secular bear market since 2000, and I think goes a long way to my view that it's an Elliott wave, a fourth wave. So if I start going down the ladder, if you will, the annual copper curve is negative. It's got a bearish bias now, but the copper curve based on quarterly data currently has a bearish bias. The copper curve based on monthly data has a bullish bias, has had a bullish bias since last April, I think it was. But that's due to peak this summer. I think it could peak in May, June. So that suggests that this big bear market rally we've had since last year, I think, is in its latter stages. And then the weekly copper curve, based on weekly data, also has a bearish bias. So you'd make a case that 4 out of the 5, I guess that's 3 out of the 4 primary trends from the copper curve have an underlying bearish tone to them.
Walter Murphy, it has been fantastic having you with us today. I feel like we've just barely scratched the surface of so many topics. We're going to have to get you back with us. Before we conclude, is there anything else you'd like to mention before we go?
No, I think if I had to mention 2 things, the decline from 2007 was, in my view, clearly corrective. The rally since the March lows was clearly corrective. It's a bear market rally. We probably have to go through a bigger test, but the ultimate conclusion is that this is the 4th wave and there are still higher highs out there.
Still higher highs out there, and it's not this financial crisis you're worried about, it's the next one. Well, that wraps up today's MTA podcast. From Seattle, I'm Ed Carlson. You can follow me at seattletechnicaladvisors.com or contact me at ed@seattletechnicaladvisors.com. Send us your comments and suggestions. We really do want to hear them. Let's keep our stops tight. Good day.